Good morning. Over the past couple of years, I've been very interested in that there's been a US consensus of economists that the US was about to go into recession. The majority of market economists have believed that for the previous couple of years, and the reason for that was that the yield curve was inverted. Short-term rates were higher than long-term rates. My argument was that even in that circumstance, you couldn't have a US recession because the budget deficit was so large and there was so much stimulus being provided to the US economy that would keep growth strong. And I've talked about that since as being a wartime stimulus in a peacetime economy. Now, the rather startling result of a lot of that budget stimulus, particularly the Inflation Reduction Act, which encourages building, for example, of electric cars in the United States, another big spending parts of the energy transition, and also the CHIPS Act, is that you've had an enormous explosion in expenditure on non-residential structures, manufacturing is how it's described within the US data. And here's the chart shown from the Federal Reserve Economic Database showing that dramatic explosion. There are a number of different slides which are less dramatic, but I thought that this would show how heroic this amount of spending was and the rate of factory building is. Now, previously in the scenario that I provided a couple of months ago, what was supposed to happen is this was supposed to top out in the second quarter of this year and then start falling. But unfortunately, it decided to continue to go up. And after a 31% annualized growth in this spending in the first quarter, that was followed by a 22% growth in annualized spending in the second quarter. But hopefully, in the part of the chart you can't see because it hasn't happened yet, what the current scenario now is that this forms a plateau. Basically, it drops from about 20% growth to about 1% growth and no growth in the final quarter. And then next year begins to decline. And the rate of decline of this manufacturing construction spending is pretty significant. 24% annualized in the first quarter, 12% in the second quarter, and 12% in the third quarter. And then it gradually drifts away. And as that happens, the US economy slows down. So the US economy in the second quarter, faster than we thought, 3% annualized. That should slow to 2.8% annualized in the third quarter, 1.9% annualized in the fourth quarter, and then 1.8 through to the balance of 2025. What that means is that for the full year in 24, the annualized growth rate is 2.7%, and that drops to 2.1% next year. Well, that's stronger growth. I thought, gee, does that knock over our forecast for cuts in the Fed funds rate? So I ran the Fed funds rate model, and the Fed funds rate is still in line for very significant cuts in the short term because it's not about growth. It's not about the fall in growth. It's about the fall in inflation, which is driving the Fed funds rate model down. So the Fed funds rate currently stands at 485 basis points, which is after a 50 basis point cut. Our model says fair value is 349. Hey, let's say 350 basis points, and that means it can fall 1.35% from now on. And I think rates will fall at 25 basis points every meeting, pretty much until that happens. We compare that to the RBA model, where the model is 4.2% and the actual rate is 4.35%. So there's really no prospect of rate cuts in Australia any time for the next couple of quarters. For those interested in policy or prospective policy in the election, and I'll do more about this in future meetings, but there was a terrific interview which you can find on YouTube between Trump and John McElwaite, who was one of the toughest guys on Bloomberg. And before that, he was one of the toughest guys on CNN. It was interesting for me because it was the Economic Club of Chicago. If you've been to Chicago, you've seen the Trump Tower. You'll see Trump has a significant presence in Chicago, it was an extremely interesting discussion about tariffs, which I'll cover in another area. Micklethwaite took up the issue that there's a lot of economists, consensus of economists, that inflation will be higher under Trump than under Biden-Harris. As to my view of that, of course, and I've written about this before, is if you actually look at the record that when Trump was doing these exactly same sort of policies that he's talking about introducing now, in his first term, the average inflation rate was 1.8%. Running the numbers this morning again, prices are up so far by 22.2% under Biden-Harris, and the average inflation rate is 4.4%, about 2.5 times the level under Trump. So, and that, of course, that happens because of very large amounts of deficit spending. But hey, that very large amount of deficit spending is providing strong earnings growth and keeping the stock market strong.